Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist here at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Securian Financial. We are joined by Tim Go, Regional Vice President for Securian Financial, and today we want to help you have more productive long-term care planning conversations. We hope this helps you uncover more clients in your own book of business. Now, before I turn it over to Tim, I just want to mention that if you have any questions throughout the presentation, you can go ahead and type those into the chat box or question section. Either works, and we will address those at the end of the presentation. So without further delay, Tim, I'm turning it over to you.
Awesome. Thank you so much, Brittany. And thank you, everybody, for joining us this afternoon. Like Brittany mentioned, my name's Tim Go, and I am the Midwest Secure Care Regional VP for our Secure Care product. So Art Jetter falls within our territory. So no matter where you are in the country, as long as you contract with Art Jetter, of course you go to Brittany, but I'm your guy for Secure Care, at the carrier level. So today we're going to talk about how to present a long-term care solution to a client. So we're going to keep it high level and really help you step by step start that conversation. And if you're new to the conversation, we know it can be a little intimidating to know how and where to begin. So again, this is really meant to give you a rough blueprint on how to present the actual long-term care solution to a client. So at a very, very high level, right, it's solutions-based selling. So presenting a long-term care solution to a client can be challenging, it can be tough. The reality of aging, and especially the need for care as we age, it's difficult for most of us to think about. But a successful long-term care planning conversation, it acknowledges the risk of not preparing well for a possible elder care event, and it focuses on the possibility of designing the best or ideal outcome for our clients, now should they experience an elder care need. So that solutions-based process, that selling process, it's really down to 4 steps. Help your clients understand the basics about why long-term care planning matters. Fact find to understand their needs, address client concerns, and present a solution custom fit to address their situation. Helping clients understand why long-term care planning matters it's a broad topic that can cover a lot of ground, but you'll likely want to steer the conversation to 2 main points. 1, the risk of needing care, and 2, the impact of long-term care expenses can have on income. Now, how you approach these 2 points, it depends on your type of the occupation. If you're introducing the topic of long-term care planning as an insurance agent, you might focus a conversation on the risk of needing care and how you can help protect a client from the impact of that risk. If you're a financial advisor, you might explain that your role is to help ensure the client has the best possible income or investment outcome, and long-term care protection can help put the client's portfolio in a more favorable position. Now, regardless of your role, every plan starts with a vision for the future. For most clients, one of their main financial goals is to plan for a retirement that allows them to live their lives to the fullest. This can involve setting financial goals to be sure that they're able to live the life they desire. Now, they may have personal goals, such as traveling or spending more time with loved ones, and they may recognize the retirement income and savings may need to last 20 years or longer. So most clients plan for phase 1 of retirement, the fun phase, right? Retiring from their workplace, creating a lifestyle for their time, traveling, golfing, fishing, shopping, joining clubs, etc. Many of us anticipate and plan for the income needed in this phase of life. Now, clients frequently don't plan for phase 2 of retirement, the phase that is often called aging in place. This is when clients start to slow down and may need assistance and help with tasks around the house. They may even end up needing help with everyday activities of living. This phase of retirement may require additional income to support these added care costs and medical costs on top of the lifestyle income clients had planned for and still need. There are a lot of different ways to articulate the risk of needing care. Some folks use statistics and studies like the average lifetime cost of care and how many adults will need care as they age. Now, for proponents of this angle, we have a piece that we can share after the call called What's Your Care Plan? It's an infographic. It can be a great tool. It highlights key statistics that you can use to help steer clients toward understanding why long-term care planning matters. For other folks, excuse me, the best way to talk about the risk of needing care is by telling a personal story about a loved one's experience with aging. Some of our most successful producers, they're going to use a combination of both approaches. When you can contextualize facts with a personal story, you can help clients begin to make the connection from, well, that's just something that could happen to someone else, to that's something that could happen to me. However you choose to focus the conversation, there are a few key notes you're going to want to hit. Making a plan, it's not just about planning for if the client gets sick, it's about planning for longevity. The longer we live, the greater the likelihood we're going to need help as we age. Now, Medicare, it doesn't pay for most long-term care expenses. In fact, it won't pay for any long-term care expenses after 100 days. And Medicaid only kicks in when our assets are depleted, and it typically only covers facility care. The cost of care is rising, and you can localize this to the client by pulling the average cost of care in their state today and comparing it to the future. So to top it all off, there's a current and projected future labor shortage in many care sectors. So many of you have probably started to recognize this. We're starting to see more news articles come out. We're starting to hear more stories from clients because the baby boomers are turning 78 this year, the silver tsunami. So while it's too late for a lot of baby boomers, it's their kids and their grandkids and their family and their friends that are currently living through this phase of life and through this crisis right now. All right, so the opportunity has never been better. There's never been a more important time to have this long-term care conversation because many, many Americans and their loved ones are dealing with it right now. So once you've established the risk of needing care, the next step is to connect the risk with the client's own retirement income. So if you can envision one of your baby boomer clients, right, somebody that's actually might be going through this right now, you know, if you compare that with a typical retirement portfolio, they might have a small pension, some cash or investments set aside, and a majority of their retirement savings in a 401k or IRA. This client's 401k and IRA, think of it as a bucket of money saved for retirement. And their retirement income is a planned stream that they're relying on to pay for their living expenses. Now imagine they live into their 80s and need long-term care. They're now solely dependent on the same bucket to continue providing needed income plus additional income for assistance or care. This double tap bucket is now pouring out two streams of income, and they may run out of money faster than anticipated. Additionally, they will be paying for care with taxable income. Their opportunity to have the type of care they want may be limited, and any legacy they intend to leave behind, it may be in jeopardy. So understand client needs. So statistics, right? Let's talk a little bit more about some statistics. Among respondents to the 2022 Insurance Barometer Series, the reported rate of long-term care ownership rose from 15% to 18% in 2020. Now that represents a 20% increase in 1 year. And in 2022, 60% of respondents say they need long-term care insurance. So it suggests that COVID raised the perceived need for long-term care coverage. Consumer interest in long-term care planning, which increased dramatically in recent years with the impact of COVID, shortage of caregivers, state, federal legislative discussions around consumer unpreparedness. Your client may have some interest, but not have an opportunity to talk with anyone about it. The fact finding. Effective fact finding for long-term care planning will be centered around four main questions. Where do clients want to live and receive care? Who do they want to provide care? What are their wishes for the care they receive? And how do they plan on paying for care? So we have two pieces to help with fact finding. First is our long-term care chronic illness quick questionnaire. It's a quick, easy way to open the conversation and help clients begin to articulate their future long-term care plans. And our second piece is a worksheet that guides clients through the process of how to create a long-term care plan. The worksheet is designed to help your client take a closer look at each of these 4 key questions. And the goal of this planning piece is to get your client to think at a deeper level about what they really want out of this stage of their life. That how to create a long-term care plan piece as a wholesaler is our most in-demand or most popular marketing piece that we have. It's a very effective tool for you to use with your client to get the conversation started, to have as a leave behind. So again, this is something that we can send out after the call, and I highly recommend you take a look and utilize with your clients. So part of that worksheet, there are several factors to consider, right? Where do you want to live? This part of the planning process is important for families to think through and evaluate what their desires and needs may be. So it could be, how can we design a plan for spouses to stay together or family to remain close? What living arrangements or amenities are crucial for their lifestyle? And do they want to prioritize staying in their house, or do they want to consider downsizing, and what that would look like? The worksheet that helps clients begin to think through who is going to be involved in their care. So as we age, our mental faculties, of course, may begin to deteriorate. So who are the key parties clients want to identify for managing the care? Mediating family and loved ones' concerns, helping with medical situations, caring for home, managing finances. Should the client engage a power of attorney, identify a qualified geriatric care manager, or identify a trusted financial professional to help manage their affairs? And what does the dream plan look like? Now, help your client envision and paint a clear vision of their desire and goals. Is this plan and desire, is it written down for loved ones to have and to see? Encourage them to engage their spouse and kids or any other interested parties in this vision, and let them voice their concerns or be a part of the process, and get them on board to make this dream a reality. So after you've got a handle on your client's needs, the next step is helping them look at their retirement assets to decide what assets they're going to use to make their plan possible. So after evaluating the assets and the income that a client may have available to them currently or in retirement, you want to calculate the risk of not preparing for care costs. So will their projected retirement income support their lifestyle plus an extra $5,000, $10,000, $15,000 monthly in additional care costs? What would that do to their retirement assets or plan? And what would that do to their legacy and what they intend to leave behind for their kids or grandkids and charities? Even for folks with significant wealth, it's important for them to be conscious of where their assets are held. Would they have to liquidate investments and holdings? Would they be drawing from taxable sources? More than likely, there's a planning vehicle that would be a smart investment for them and potentially put them in a more tax-advantaged position for funding care costs. Going through the fact finder with your client will help you develop a clearer picture of their future goals and concerns. And understanding their goals will help you make a recommendation, but understanding their concerns and making sure you address objections is critical to making the right recommendation. So before you go through any recommendations, you want to check in with the client. Make sure you're meeting any objections. One of the most important parts of this entire process is to cement in the client's mind that this is a joint plan, not just something you're selling. Addressing any objections is how you can help best accomplish that. So we have another piece. Our overcoming objections piece has some of the most common objections laid out and possible responses to them. I'm not going to read all of them, but I'll read a couple. So there's one which I find a little humorous in a morbid way, I guess. But it says, I don't think I'll need care. My mom, my dad, they died at age 65. I'm not going to make it. I'm going to croak before I need long-term care. All right, you may respond, you're right. You may not live a long life. You may not need care. But if you do, you should consider the consequences to your family, right? If somebody says that to you and they have retirement assets, well, you can ask them how long they expect their retirement to last. Many people plan their retirement portfolio to pay out until at least age 90. So why would they need this if they expect to die early, right? You start to frame the need for long-term care as a financial hedge, which it is, but framing it in the sense of retirement care clients can help connect the dots for a lot of people. Another objection that you may hear is, I don't want to involve my children. I'll just take care of it myself. Of course, you can say that, well, your children love you and you want to make sure that you're well taken care of. And you can mention that you've seen how beneficial it is to have the children involved from the beginning in the process so they're informed of all the desires and decisions. It is crucial to have the family involved from the very beginning and to have a plan of action. There are many instances of claim, and I'm just talking in general, I'm not talking at Securian, but any of you who have dealt with a long-term care claim or have heard about it, may hear that, well, the claim hit and no one knew what to do, right? The kids didn't know where to go. They didn't know where the policy was. Sometimes they don't know that there's a policy. And the mental faculties of the parents may not be there anymore. So trying to figure everything out during a very stressful time is a very, very stressful, situation for everybody involved. So whether they want to or not, family will be involved at the time of a long-term care claim, so it's crucial to include them as early as possible. So now, after you've gone through all that with your client, time to solidify their plan, how to make it a possibility. So when you're discussing and recording their long-term care plan, it might be prudent for them to think through several what-ifs and have planned accordingly. Help your client develop a good, better, best plan depending on what happens next. So what if they are diagnosed with Alzheimer's disease? What if they have a debilitating stroke? What if they live a wonderful full life and they just need help with their activities of living? You want to discuss intentions and plan with family members, like I mentioned before. You want to review wills, trusts, and powers of attorney. Identifying key parties, again, identifying who's going to be in charge in that situation, who's going to manage the care, who's going to be the geriatric care manager. You want to mediate family and loved ones' concerns, spouse or child. You need to decide who's going to take the lead and help manage their finances from attorneys. And you being the financial professional, you may be authorized to help, depending on the family and what they wish. Then you can review solutions to make the care plan possible. So what are the solutions designed to help? Can we create additional income to make the best plan possible? Can insurance protect us enough to ensure we can implement at least our good or better plan? And are there safety nets to make sure we don't run out of money? By going through this process with the estate prior to the very end, right, really solidifies you as looking out for your client and their estate in a very specific scenario. So in the event that a long-term care event does happen, extended care event does happen, you are in a very good position with that estate to help manage finances and to help make sure everything goes smoothly so that as the estate turns over, you as the financial professional are in a very, very good position to continue working with that family even after your primary client has passed away. So let's take the time to review some different potential solutions available to clients, right? Traditional long-term care insurance protects assets from extended healthcare events, right? The pros, you may be able to use HSA, HRA, MSA to fund premiums. It can be tax deductible for business owners, can be customizable. The cons of that is that underwriting tends to be very, very difficult. Premiums tend not to be guaranteed, and oftentimes it's a use it or lose it, right? You're really only buying it for pure long-term care. There's not going to be a death benefit or a robust death benefit or a robust return to premium. And you might not know what the premiums will be at the time that they probably need it the most, right, down the road. So there are use cases for each one of these solutions, but in today's market, from what we're seeing, we tend to see a lot of the traditional long-term care insurance taking a backseat to more modern asset-based hybrids, linked benefit products. And of course, Brittany knows this. You all may know this. I'm biased because my product, Secure Care, is an asset-based product. But we do see the trends in the industry reflect that. Short-term care, you don't see a lot of short-term care products, right? In the older ages, the more advanced ages where there may not be a lot of other options, if there's a short-term care product, it might be a viable option. It can be a pay in addition to a Medicare benefit, but it's not available in all states. You don't have any inflation protection. The benefit period's limited, right? It tends to be very situational. It's very, very rare. And life insurance with the accelerated benefits. So you may hear this as life insurance with a long-term care rider or life insurance with a chronic illness rider, but an acceleration rider and only an acceleration rider. It's a tremendously popular option. And in certain situations, it's very, very robust, right? But the long-term care benefits will be dependent on the amount of death benefit that they purchase because you're accelerating the death benefit once the client qualifies for long-term care, right? So the question tends to be, well, what do I choose? Do I do life insurance with accelerated benefits, or do I go linked benefit with an inflation rider? What do I choose? And you really should put that on the client, right? What is the primary objective of the policy? If the primary objective is leaving behind a legacy and a death benefit, and they want to have long-term care be supplemental to that, life insurance with accelerated benefits is phenomenal. But if their primary objective is going to be long-term care, but they want some, return of premium options or death benefit options, then go with the hybrid product, go with the linked benefit product. And there are other pros and cons to each. And I recommend that you get in touch with Brittany and Art Jetter, and she is an expert about going through all the different options. Then you have your annuities with long-term care riders, right? Easier to qualify. It's an annuity, so you're not doing underwriting. So it's easier to qualify. Tax-free long-term care benefits, you can use qualified funds, but it tends to lose some leverage in a lot of cases, right? Because you're not going through underwriting, you're not getting as robust of benefits on the back end, but you can use qualified funds. So again, it really depends on the client and what their financial portfolio looks like and where their individual situation lies. And then you have the life insurance and long-term care hybrid products like Secure Care. So tax-free life and long-term care benefits, you have flexible payment options. So traditionally, when these products first rolled out, they tended to be single pay policies, and now we see many more options like 5, 7, 10, 15, and beyond, depending on the carrier. And with Secure Care, the long-term care portion of the policy is actually qualified long-term care, meaning that you can apply that in a business paid situation and get certain tax benefits from that. So you're kind of getting the best of both worlds, right? You have qualified long-term care aspects of the policy, but then you have the death benefit and life insurance aspect of that policy too. Can be more expensive. Underwriting can be a little tight, but we are seeing the industry move quickly towards long-term care hybrid products. Index annuities, it's very much so the same with annuities with a long-term care rider. And then self-funding. So you may hear this with your more affluent clients, right? Well, I have so much money and I don't need this, right? I will just pay for it on my own. Well, the main consequence are tax timing. Right? You're not getting any leverage with insurance. You have liquidity and flexibility, but you'd be surprised how, well, maybe you wouldn't be surprised, but assets can drain very, very quickly. Genworth actually has a very, very good cost of care calculator that I recommend you use. Securian doesn't have one right now, but Genworth is fantastic. And you can dial in per zip code what the average cost of care may be in 5, 10, 15, 20, so on, right? And then you can customize it from there to say, well, is it going to be 3%, 3% inflation, 5% inflation? How many hours of care do you think the client will need? You can vary very easily scare yourself by some of the numbers that you can put together on that calculator. But sadly, a lot of times those numbers are reality. So the self-funding argument can be valid, but a lot of times affluent people become affluent because they use leverage, and these insurance products are no different, right? This just further speaks on the leverage that they can use to protect their portfolio, right? So if they have this, before putting a long-term care policy in there, you can ask them, which assets would you choose? If you needed long-term care, which asset would you choose to pay for it? Of course, I'm going to use my most liquid assets first. It's going to be my cash. And then what? Well, my investments, or sell my car, or, toys. And then what? Retirement savings, right? It starts to deplete very, very quickly. By buying a long-term care policy, they're able to, in a way, bulletproof their portfolio, put an umbrella over their portfolio to draw from that long-term care policy instead of their assets. With that, that's all I had. Brittany, were there any questions that came up? Does anybody have any questions? Brittany, is there anything you'd like to add?
Yes, so we did have a couple of questions come through, and pretty much they're all the same, so this is going to be rather easy. So for those of you who've joined us today, probably within an hour, we do a little editing on the back end, but within an hour, I would say you will receive an email from GoToWebinar with the recorded session. So that's going to automatically come to you once we're done editing through the GoToWebinar system. Now, the other questions that came in, Tim did mention a handful of marketing pieces they have available. Our team is going to be reaching out to each of you after this call and get those over to you individually in an email. So we can't necessarily automatically send those through GoToWebinar, but we're going to make sure to get those marketing pieces in your hand. So Tim, that really wrapped up all our questions today. I just want to say thank you for co-hosting today's session. And of course, thank you to everyone who joined us. We encourage all of you to start thinking about people you need to start the planning conversation with. So with that, our team is standing by if there are any further questions, or you'd like to speak more on Securian Financial's Secure Care 3 solution. You can reach us at 800-228-0008 or shoot us a quick email at ltci@jetter.com. Again, thank you, everyone, and have a great afternoon.